what happens when the crisis, the next one actually starts? It's like the spending is going to get way out of control from here because it's only going to have to go up. Like tax revenue doesn't increase during a recession, so that deficit is going to widen substantially, and they can't afford to borrow that money out of the economy. Liquidity is already drying up, and interest rates are already super high. So that has to come from the money printer in some way.
Heresy Financials, Joe Brown is on the show today. Joe, thanks for coming back on Capital Cosm.
Yeah, thanks for having me again.
As always, guys, be sure to like this video and subscribe to the channel if you haven't already. 88% of you guys who watch this content are still not subscribed. Let's go ahead and flip that ratio around. So it takes less than a second and it's free. So if you don't mind, hit that little subscribe button on the side. And Joe, let's go ahead and dive right in, Joe. What is your economic overview? Broad strokes wise, 35,000 foot view. What do you see out there by way of the economy?
Well, I would say if we're looking long term, I think most people haven't realized yet that we are in a higher for longer environment. I talk about the long term debt cycle a lot, but many people are looking at, okay, when is the Fed going to cut again? When are we going to get back to normal interest rates where, people can afford housing again and interest rates start moving down and we get stimulus for the economy? It's like that ship has sailed. We had 40 years of disinflation and 40 years of lowering rates, and that ends when rates hit zero and inflation starts, which happened in 2020. And so the next at least decade is going to look a lot more similar to the phase of the debt cycle that preceded the last 40 years, which is like 1940 through 1980. There are some similarities, like we've got the potential for things like yield curve control coming down the line. The government debt to GDP ratio is 120%, just like it was in the early 40s. And so we've got this long road of government deleveraging that must take place if they don't want to default ahead of us. And the way they do that is through printing. So the government won't be able to afford its bills. That has to get printed. That debt is monetized, in other words, through something like yield curve control or a big, burst of debt monetization through QE, something like that. And then that newly printed money gets spent into the economy. That drives up prices. That keeps interest rates high. And we have a cycle that looks very similar to the 40s through the 80s, where interest rates and inflation both move higher as the government deleverages from a debt to GDP standpoint. I don't think most people have realized yet that like this is the new normal. Like we're not going back to 3% mortgage rates or 4% mortgage rates, maybe for decades.
Hmm. So you think we can maintain higher for longer despite the debt burden that the U.S. government has?
No, the debt burden is causing higher for longer. So that's I think the main confusion out there is people think, okay, well, the government can't survive if interest rates stay this high. And that's true if there's no intervention. They eventually get to the point where they default, but that's not the way that it rolls out. You get debt, and the government then finances its expenses through the printer instead of through debt. So yes, on paper, it looks like, hey, they're paying 5%, 6%, 7% for their debt, but it doesn't really matter if the money to pay for that is coming from the printer at the end of the day. And there's mechanics involved in there where it's not, I'm explaining it in broad brush strokes, but at the end of the day, that's kind of the end result.
Gotcha. And you did mention the yield curve. The yield curve has inverted the 10-2 spread there. We are in the longest ever inversion of the yield curve. What does that imply?
Well, historically, that means that we're going to have the deepest and longest lasting recession. Like historically, a lot of times when you have, anytime you have an inverted yield curve, it is followed by a recession. The difference comes into how deep that inversion is, and then how long it lasts. And so the last two that were around the same length resulted in the one of them was the financial crisis, and then I can't remember the other one, but they were both extremely deep recessions. And so that doesn't indicate, economic strength. Just like it doesn't mean like this time is different because it hadn't happened yet. It's like, okay, well, that the snapback, that rubber band finally getting released, could be potentially bad. And that's another reason why you look at, okay, well, if the government is spending deficits that historically to this level has only been used during times of extreme financial crisis. What happens when the next one actually starts? It's like the spending is going to get way out of control from here because it's only going to have to go up. Like tax revenue doesn't increase during a recession. So that deficit is going to widen substantially, and they can't afford to borrow that money out of the economy. Liquidity is already drying up, and interest rates are already super high. So that has to come from the money printer in some way.
So, what do you make of the BOC, the Bank of Canada, and the ECB having already announced rate cuts by the tune of 25 basis points, but rate cuts nonetheless? Uh, do you think they'll continue down that path, or what's your take there?
Maybe. Yeah. And I'm not actually really looking at something like that as indicative of whether my thesis here is correct or incorrect. Because if you look at what happened during the 1940s through the 1980s, there were significant periods of time of rate cuts. There were like, it's not a straight line. And similarly, from 1980 through 2020, it was not a straight line down. There were times when interest rates went up. And so you definitely have moves up and down along the way, but the longer term trend is going to be up. So yeah, we're going to have times where, especially if the inflation numbers come down, like if we hit a recession, what is a recession? It's falling prices. Like, so absolutely, if something like that happens, the Fed's going to say, okay, well, the economy's in trouble. If we keep rates high, it's only going to make things worse. So we're going to lower interest rates. And so absolutely something like that could happen in the short term. And I'm not saying that that's not possible at all. What I am saying is we're not going back down to zero. We're not still in that phase where things are continually getting lower and lower with brief periods of up. We're in the opposite now. Things are heading higher and higher with brief periods of lower.
Now, are you talking about pure deflation or stagflation, i.e., supply side inflation coupled with uh, diminishing growth or negative growth?
That depends. I mean, because anytime we're talking about anything in economics, the implied understanding is all else being equal, right? And so, like, this is where there's a big fight between one of your guests recently, good friend of mine, Keith Weiner. He rails on monetarists all the time and talks about how like it's not about the money supply. Um, and he's correct because in reality, nothing is all else being equal. Like you can't just isolate in an economy that's dynamic and complex with, quadrillions of moving parts, one variable. But if you could isolate just that, then yeah, you double the money supply. Everybody who had $1 before now has $2. Everybody who had $1 million now has $2 million. You double the money supply, similar to like a stock split. Then yeah, the prices are going to extremely react to the upside. And so you can't do that in reality. So you have to look at what are the other variables that actually make a difference here. And productivity is something that is like a complete wild card to me at this point. Like it's very possible. Like if you want like a silver lining or an optimistic outlook on the future, it's very possible that we experience a big deleveraging here without actually feeling the pain of that deleveraging. So first, let me give you the household example, and then we'll talk about how this applies to the economy potentially going forward. Um, let's say I make 50 grand a year. Let's say I spend $10,000 on a coding boot camp. And at the end of that, I'm able to get an entry level programming job for $100,000. So I went from a low income state, levered up, and then used that leverage to be more productive. And now, even though I have that $10,000 that I owe back, I'm much better off. My net result that first year, let's say I pay it off that first year, is that I've got $90,000 of income. So even though I leveraged up and then deleveraged, I'm much better off. I didn't feel the net pain of that deleveraging. And I'm still better off than where I was before making that $50,000. So the economy, we can absolutely see something similar take place. And in fact, when you look at all of the big, jumps in productivity, the agricultural revolution, the industrial revolution, the information age, like technology and the internet, like these are all things that drastically expanded productivity and the total wealth in society so much that there was deleveraging going on at the same time. It allowed us to get out of some of that pain. And so that's why we didn't experience a lot of the inflation that we should have if all else was equal over the past 30 years, was because we had this big deflationary force of technology increasing production, increasing productivity and total wealth. So we can see that trend continuing potentially. Like we're on the verge, maybe, of a big renaissance in nuclear technology. I mean, the sheer number of dollars that are about to flood into nuclear. Like I'm really excited about this. Like Bill Gates recently came out and said, like I'm ready to just start plowing billions of dollars into nuclear. Amazon just bought a nuclear power plant. Sam Altman, the OpenAI guy, he just took a company public, Oklo, and they make small modular reactors that are fueled from nuclear waste, spent fuel rods from other facilities. And there's this big push by big money and tech, especially because everybody's waking up and realizing that's the only option that we have. If we want to have enough energy to supply our future energy needs, the only option that we have is nuclear, let alone the fact that it's actually green and clean and safe. Just the sheer amount of energy you can produce from nuclear alone, it's the only option. The only reason why it's expensive is because of regulation. So we're having big money push to change that regulation right now. And we could see a big explosion in that. And if you look at GDP growth and consumption of energy, they're correlated almost 1-to-1. And so if we get this big explosion in energy production that makes energy costs cheaper, that means we can consume more energy for the same cost. That increases total wealth, all of the downstream effects of that. So that's one big thing we have potentially, good for us moving forward. Another one is we're potentially on the verge of like AI really taking off and making companies and individuals a lot more productive. I mean, imagine if you didn't have to pay somebody to do something that you pay for right now. You could have a program for free do that for you. It's like you've got more money left over. Like that's a net wealth increase for everybody. And that extrapolates. You can just filter that all the way through all of society. Now you take that one step farther and say, okay, well, look at like companies like Tesla. They're developing the Optimus robot. And if they crack this AI thing, then it's like in the future, maybe it's not 5 years from now, but at some point, we have robots doing all the manual labor that people don't want to do. It's like every time in history where we've been able to say, okay, humans no longer have to do that manual labor that we don't want to do. Bam, huge explosion in wealth. It's like once we stopped farming and allowed animals to do it for us, and then went from that to like tractors and machines doing that for us, and moving from like brain calculations, allowing computers to do that for us. It's like we have this big explosion in total wealth, and we're on the verge of another one of those potentially through like artificially intelligent machines. So we've got some things that could explode the wealth that would allow us to not experience the pain. Even though that deleveraging still happens, it would allow us to escape the pain of it.
Yeah, and to kind of add more fuel to the fire there, Joe, I interviewed Jim Thorne the other week, and he was telling me how, in terms of AI, there still is not a fully dedicated AI company out there, right? And in the same way, that you have a fully dedicated tech company. But he said that Tesla was on the verge of becoming that AI company. You think about all the data they're collecting. It's all spatial data. It's not just, scraping the internet for text like all these other, like Chat GPT and et cetera do. This is picking up spatial data that no one else is. And yeah, I mean, we still haven't seen anything when it comes to this AI story, albeit, do you see this as something akin to, the 2000 or, the late 90s story where you may have been right about the tech boom, but the stocks may have gotten a little too ahead of themselves. Do you see that today with NVIDIA, with Microsoft, with Alphabet, the Mag 3, the Mag 5, whatever you want to call it, essentially making up the bulk of the stock market today, the stock market's ascent up?
Yeah, 100%. It's very, very difficult, if not impossible, to identify a moat that's large enough to survive into the future to see like who will be the winners. It's very, very easy to see, hey, if things continue at all like close to the current pace in 5, 10, especially like 20 years, AI is going to be very, very well integrated into our lives. And there's going to be some very big winners, just like the internet and email. Um, but ahead of that happening, it's very, very difficult to see who the winners of that will be. You're going to have a lot of false expectations of growth that won't pan out. It's even the application itself. It's like there were a bunch of a good example of this that's happening, like a microcosm of this is like there were a bunch of small startup companies that were powered by like Chat GPT. They were individuals and small companies launching their own apps saying, hey, we AI does this for your photos, AI does this for your videos, AI does this for your writing, your all these features. And so there's all of these different companies trying to be the next application of AI in this different area. The next version of iOS comes out. It was just announced, I don't know, what was that, like a month ago, and it's going to be released for everybody in like, I don't know, a month or two. And AI is so well integrated into it that it's like it's gonna kill like the majority of the AI powered apps in their own app store. Not to mention some of the other things, companies and programs that have existed for a long time, like Grammarly and Descript, some of these OG companies that have been using software and machine learning and now recently AI to do like writing for you and automatic, editing of your stuff. It's like that's built into the Notes app now for free. Like it's very difficult to identify some of these companies that have potential for major growth because it's this kind of grand broad awakening at everybody at the same time is having access to the same advancements, and it's like it's just a race to the bottom in terms of pricing. And yeah, Apple can destroy you, and then in a couple of years somebody else can come in and potentially destroy Apple. So we don't know who the winners will be. There will be winners, but it's hard to invest um, uh, in a safe way with a high certainty of success for something like that.
I will say, as a data scientist, there is a danger. There could be an unintended consequence where AI might fall victim to its own success, and that's by you look at where all the money is flowing to in AI research today. It's all towards developing LLMs, large language models. Now, AI is much more than LLMs, right? But what you're seeing today is this huge sum of capital, efforts, energy just being devoted to this one sector of AI that's already gotten a pretty good, you could make the case that, the point of diminishing returns we may have already hit. So it's an unpredictable road ahead. I'll just put it that way, because we don't
Yeah.
know. Yeah, because AGI, artificial generalized intelligence, is much more than just spitting out like a glorified version of autocorrect. You're supposed to mimic, things on a spatial nature, on an auditory nature, movements, and all of that stuff. It's all comprehensive. Um, you mentioned nuclear. So am I to presume that you're bullish on uranium, Joe Brown?
Oh yeah, extremely.
Okay. Well,
Yeah.
what's your take on the current uranium space right now? It feels like it's kind of in a doldrum. The uranium price hasn't really moved too much. What's your take on uranium?
Well, it broke out of a very long period of price consolidation. What was that? Maybe almost a year ago now, and had an explosive move upwards. It hit a natural area of resistance where a lot of uranium mining companies suddenly become profitable. Like when it's at a lower price, it's like we can't pull this stuff out of the ground and then sell it for more than it cost us to pull it out of the ground. Now, many uranium companies can pull uranium out of the ground and sell it for more than what it costs them to pull it out of the ground for. So there's a natural level area of resistance there. And so I'm that's not to say that I'm not incredibly bullish on it moving forward into the future. I'm just not expecting the same move that we've had over the last year to continue for the next year. It would be completely reasonable for it to stay stuck in a range where it's at right now for at least a while. Um, the reason why I'm bullish on it past this point is because the needs for energy. And I think in the next 2 years, 3 years, the number of new facilities that we're going to see being built around the world, it's just going to explode. And very quickly, the market's going to realize even if every mining company comes online, 100% capacity, we have nowhere near the production that we need in order to supply for all of the facilities that are going to be coming online. And so I am very bullish on it into the long-term future, like 3 years plus. Meantime, who knows? I'm not really concerned about the more short-term movement right now.
Where else do you see opportunities out there in the market? There's a lot of doom and gloom out there, but do you see any silver linings on the horizon?
Um, yeah. So in periods of time like this, one thing that really tends to do well is more active like value investing. We see like when we see big concentration in the stock markets, the broad indexes like this, where most of the performance is driven by a few winners, those kind of things, those are temporary and they reverse themselves. You've got flash crashes. We're going to have corrections here. Like imagine what's going to happen to some of these risk assets if the Fed comes out in a couple of months and says, oops, inflation ticked back up again. It's going to be another, 6 months before we consider lowering rates by a quarter of a percent. And so we've got markets pricing in optimism where it may not actually exist, and valuations are extremely stretched here. Um, but we've got on the same token, it's like there's a lot of names that are really undervalued right now. As a result, like most of the index performance is driven by a few outperformers that are way overvalued, and there's not a lot of money pouring into the stuff that is undervalued right now. You also have, in this kind of more longer term cycle, you've got hard assets. I'm very bullish on gold, silver, other commodities, like Brazil, that are more heavily commodity driven. There are a lot of opportunities where it looks like there's just no way around the demand outstripping the supply, and the price moving upwards as a result.
Gotcha. Well, how do you identify opportunities though? Like, do you use technical analysis? Do you use a combination of technical analysis and fundamental analysis? What's kind of like your methodology?
Yeah, yeah, everything, both. There's for anybody just as a kind of an intro, there's top-down investors, which is like, okay, here's the overall macro environment, bullish or bearish. Here's what interest rates are doing. Here's what inflation is doing, whatever. And then you dive down into there and say, okay, well, of that, it's like, all right, tech is doing really, really well. And then in there, it's like, what are the best players inside of tech? That's more of like the top-down approach. And then there are bottom-up investors. I'd say this is more like the Warren Buffett model, where you're just looking straight up at the lowest level. You're looking at the company, like you're looking at the balance sheet, you're looking at the financial statements, you're looking at the cash flow, you're looking at the earnings, you're looking at the management, disregarding everything else. You're going, bottom up. Um, I like doing both. I'd probably say I lean more to the top down style. And then in terms of most of my investing, I'd probably lean a little bit more short term, a little bit more swing trader. That's just my preference. Not necessarily the best. I would not necessarily recommend that. But I do prefer that a little bit more. And so for that, you have to incorporate technical analysis. It's like in the short term, the fundamentals, both macro,
Right.
top down and bottom up. If you can get all three of those to align, then you've got a really great opportunity in front of you. Some things where that has happened in the past, like I made some public calls on MicroStrategy last year, resulted in a huge, huge, huge move up. The with uranium as well. Recently, in my private membership group, made a trade recommendation went out for Tesla, and that's already started making a huge move. So there's some areas where those kind of line up, where the macro and the technical and the bottom up stuff all come together. And so those would be three recent examples of that. But yeah, yeah, there's no shortcut. You kind of have to put in the time, put in the research. And you have to record your losers, learn from your mistakes, see what caused you to take the loss, make sure you're managing your risk and never taking big losses, always taking small losses, and learn your lessons along the way.
Hey guys, quick pause. Are you looking for a new stock trading app or just want to diversify where you put your money? Maybe you want a plan B, a plan C when it comes to your stock brokerage apps. Well, I've got a special offer for you. It's from Moomoo, and you get a special 8.1% APY on uninvested cash. That's right, 8.1% APY. And if you deposit $100, then you get 5 free stocks. If you deposit $1,000, then you get 10 extra free stocks for a grand total of 15 free stocks, potentially, depending on how much you deposit. This won't be here forever, though, so be sure to claim your offer now. Link to that is down below. Moomoo has all of the amenities of your typical stock trading app. 100 plus technical analysis and drawing tools, 0 commission, 6.8% margin rate, 0 equity option contract fee, and more. So check them out, link down below. Let's get back to the video. Yeah, without any reps, I mean, you've essentially just reduced trading into buying a lottery ticket. So we do have an election coming up in November. It's Trump versus Biden or TBD. Who knows?
TBD.
Yeah. What are the material differences that either candidate could make, in terms of the economy, the markets in general? People tend to put tons of hope on politicians to, solve things along the lines of the economy, among other things, obviously. But let's just stick with the economy in this case. Do you see any substantial difference between the two in terms of what they might do to better affect the market or the economy?
No. If you look at this, is something that both sides will hate. Hate hearing stuff like this, but just take a look at the last 10 presidents. Look at what the national debt did for each president. It just grew. Look at what the GDP did under each president. It grew. Look at what the stock market did under each president. It grew. Look at what the inflation rate was under each president. It grew. I mean, obviously under Biden, it's a little bit higher, but substantially higher. But what most people don't like to hear about that is that a significant amount, like the trillions of dollars of the spending that resulted in a good chunk of that inflation was authorized by Trump. Like the first trillion plus spending package in 2020, that was 2020. It wasn't 2021. So the deficits, the debt, the inflation, markets, GDP. It's and I'm doing the research on this right now, so it's funny that you ask about it. When you look at the averages of each year under each president, left or right, there's no difference. It's all the same, left or right. And a lot of people think of Trump as conservative, fiscally or economically. It's like, man, he was blowing up the deficit and the debt before 2020 ever came along. And then when you count that in, it was like, man, there was, an insane amount of spending there. But still, there's really no difference. There's two sides of the same coin. Nobody's coming in to solve the issues, because the only way that you can actually solve the problems is by doing things that are politically unpopular. You have to cut the spending. And what are they spending the majority of the money on? Social Security, Medicare, military. It's the things that nobody will ever cut the spending on. And so what you have to pay lip service to the stuff that people think that they care about, even though it doesn't move the needle.
Yeah. And on top of all that, we've got major wars happening in Europe by way of Ukraine and Russia. We've got things going on in the Middle East. Taiwan and China is a potential powder keg there as well. South Korea, North Korea. So my question to you, Joe Brown, how do you prep financially, economically for black swan, like geopolitical uncertainties? It seems like the world is at a precipice right now. So how do you kind of prep yourself, financially speaking, for whatever may lie ahead?
Yeah, just buy index funds and hope and pray that they don't crash. No, I'm just kidding. No, you have to. I like intelligent hedging. where it's like, okay, if you look at an index fund or an actively managed ETF that is like a hedged equity fund, what they have to do is they have to take your money and they have to say, okay, let's say 5% or 10% of this is going to be spent on hedges on a rolling basis. That they're just burning your cash. It's like that's not a smart thing to do. So you have to take a look at, okay, when is um, risk not being priced into the market? And if risk is not being priced into the market, then I'm going to bet on it in the future being priced in. That's when that hedging is cheapest. And that's when the outsized returns happen as a result of the risk suddenly becoming apparent. Like for an example of this, like you meant because you mentioned Taiwan. Um, Back in, I believe it was 2021, it might have been 2022. I don't know if you remember this, but there was I don't want this video to get flagged, so I'm going to speak a little bit cryptically here. Um, there was a very free nation in the East, in Asia that was not considered to be its own nation by another larger nation. And then during 2020, there was what some called like a takeover, and now it's not it's not has very little independence anymore. As a result of that, the stock market in that former independent area crashed, like it tanked, HK. And if a similar thing were to be attempted in Taiwan, then you would expect the stock market to react somewhat similarly there. Well, in 2022, I believe it was 2022, so maybe it was 2021. The stock market in Taiwan was at all-time highs. It was literally pricing in zero risk of anything happening there whatsoever. And so I looked at that. I was like, okay, well, I'm not saying that there's definitely going to be something that'll happen here. I'm just saying that the market's pricing in a 0% chance that something could. And so if the market starts pricing in a 10% chance that something could happen here, the stock market's going to have to adjust down. And so you could have just, bought some very cheap puts on an ETF that tracked the Taiwanese stock market. And over the next like 6 months from there, that index fund, this Taiwan stock market, crashed like 30%, or a little bit more as it started to price in the risk of something happening. And so you have to pay for those potential risks to emerge when the market's pricing in like no chance of that risk. And so when volatility is high, that's not when you want to be hedging. You want to be hedging when volatility is really low. And most of the time you're going to lose. Like most of the time the market's right, but when the market's wrong, that's when it pays off.
Gotcha. So what I've been doing over the course of the last several episodes is I've kind of opened the door for each guest to recommend a book or two or three, however many you want, actually, that the audience should read, in your opinion. So I'm gonna offer you the same a question. What are some books you'd recommend?
Well, I'm gonna need some help to narrow it down. So let's are we talking economics? Are we talking like trading? Are we talking like investing? Like what's the focus? Just
It could be
personal.
economic, it could be investing, it could be I mean, this is an investing and economic channel, so hopefully, preferably something in those spheres.
Okay. I will give I'll give three authors.
Okay.
That'll help here. Author number one is Jack Schwager or Schwager. He wrote the Market Wizards books, and
Mm.
there's unknown market wizards, there's new market wizards, there's hedge fund market wizards, there's the original market wizards. There's it's a long series. Really interesting because his original one, he's interviewing people that are now like famous, like Ray Dalio, and back when they were smaller. And all he does is he interviews, the best investors and traders throughout history, um, just to get their insights on their success and their failures. And what you notice after you read about four or five of them is every single one of them has the same number one rule, which is risk management, like never lose money. And the same rule number two, which is never forget rule number one, as Warren Buffett likes to say. And so, risk management, making sure you're limiting your losses. Everybody does it in their own way, whether it's, margin of safety or whether it's stop losses or whatever. There's many ways to mitigate your risk. but that's the number one rule by everybody whoever makes it investing. And so it's lots of great insights in those books. The next one, I'm going to say Nassim Taleb's books, the Black Swan, Anti-Fragile, and Skin in the Game. I think Skin in the Game is my favorite, but they kind of build on each other. So I'd read them in that order: Black Swan, Anti-Fragile, then Skin in the Game.
Yeah, I got them
Fantastic
too,
insights
actually.
on life. And oh, you got them right there?
Yeah, I don't know if you can see it, but it's right there. I've got
Gotcha.
I've
Yeah,
got
yeah.
Black Swan, Anti-Fragile, and Skin in the Game.
Okay. Is Skin in the Game your favorite too, or did you like a different one better?
I like the Black Swan. That's what got me into
Okay.
to his books.
Okay.
Yeah, I mean they're all good.
Yeah. Yeah, they are. Those are good for investing and trading, but beyond that, lots of wisdom that's applicable to life as well. And then finally, I would say probably Mark Spitznagel. He actually runs the Universa Fund, which is Nassim Taleb's fund that he's invested in. And his two books are The Tao of Capital and Safe Haven Investing. And those are both very good, packed full of wisdom and some meat for investing and trading.
I see. Well, we'll have all those books listed down below, guys. So if you're interested, check out the description box. All the Amazon links will be down below. Also, Joe, we've been asking each and every guest for, again, the last several episodes to ask a question to my next guest. So I'm going to open the door to you.
I would ask him, in a world of, or at least in a nation of increasing government overreach and tipping over into potential tyranny, what is the most effective way to improve your life? Would it be A, fight back? That could include
Hmm.
talking about things, making people aware of the issues. Um, B, just completely ignoring it and saying, I can't control this at all. So I'm going to keep my head in the sand and just improve my life regardless. Like, there's things outside my control. I'm just going to focus on making money and making the life better for myself and those around me. Or is it C, to just exit the system? If you know how bad it is and you disagree with it, go somewhere else that's better. Which one of those would be most, like, if you could make that a rule for
Right.
everybody, that
So
everybody would have
essentially
to follow?
fight, freeze, or flee,
Um,
right?
I would say fight, ignore, or flee,
Ignore.
because it's not just freezing, it's just ignoring it and just focusing on improving your own life instead.
Okay. I'll let you know what he says.
All right.
The question to you is, this is from Gareth Soloway. And
Oh,
so he wants to
I would
know.
ask him to break down the underlying data, that the recent economic data. Like, for instance, we're getting the CPI on Thursday, and kind of go into what we're seeing with the underbelly of some of these numbers, where that, I don't know if he'll know this, but where inflation is still bubbling up. And again, we've seen commodity prices start to bounce recently. Oil, obviously, we just looked at that chart earlier, starting to come back up. But I would love to know his ultimate interpretation of the economy, and is it as rosy as it's made out to be in the mainstream media and in other places, or is it really starting on that path towards recession?
mm. Did he know he was asking this for me?
Yeah,
Okay.
I told you. Yeah. So he was excited
Okay.
when I said Joe Brown.
Okay. Yeah, I like him. I think that the odds are more in favor of us moving closer to like a steep recession. However, you can always paper over that. Like it becomes like a game of measuring at the end of the day, like how you're measuring things. So um, when you look at like your own bills. I saw this video popped up on social media where a guy was on his, like, it was his Instacart account, I think. And so he just scrolled through his history and he pulled up a grocery order from 2 years ago. It was 2022, I believe. And there's a button on there that just says resubmit the exact same order. So buy all the same items. And the original order was like $150. And when he hit like resubmit order, it just grabbed all those items again, but at the new prices. And it was like $470. So it was almost quadruple the price in like 4 years, which is like, I don't know the exact math on that. What is that? Like a little less than 25% per year because of compounding, like 20% a year, which is at least for food, like obviously insanely higher than the amount that the CPI shows. Now there's other costs involved in that too. Maybe Instacart's fees went up. Maybe those specific brand names were more expensive, but there's the same item with a different brand that you could get for cheaper. Like, I don't know, but that's a really good rule of thumb for like what the quality of life is going through. Because it's like, if I get a ribeye every single Friday night, and it used to be, $20 and now it's $50. Yes, you could say that there's extenuating circumstances causing specifically ribeyes to get more expensive, but that's still a good measure of the quality of my life becoming more expensive. I have to get sacrifices in order to maintain.
Right.
And you might say, well, you shouldn't be buying ribeyes anyway. And it's like, well, we're measuring the quality of life here. And so we're not talking about good personal financial habits. And so for many people, that's what's been happening over the last 4 or 5 years. It's like you're getting raises, you're getting your, inflation raises, you're getting your promotions, and it's much harder to afford life now than it was 4 or 5 years ago, because everything you have to buy, like, the diapers and the groceries and the rent and the gas and the insurance is all way more expensive, and it's gone up more than your wages have. Real wages have been on the decline for a couple of years now. And so that's the real measure of the quality of life going down. And that's just the official metrics. And so really, it's like, are we in a recession or are we not? It's like, well, officially, maybe not. And officially, we may never be. Like, there's ways to measure around that. I mean, the last time when it was like, hey, we have 2 consecutive quarters of GDP in decline in a row, they were just like, nope, not a recession. Like, doesn't count, because we just decide, when is a recession. It doesn't matter that that's how we used to always just classically define it. We're just, not using that definition now because of, the labor situation. And so you may agree with that or disagree with that, but the truth is, it's just a game of measuring. And so we really can't know, like, officially recession or not recession. I mean, if things get bad enough, we'll definitely know, right? But from everybody's own individual standpoint, it's a lot easier to measure. Is my quality of life getting better? Do I have more income relative to my expenses? Is my net worth growing relative to my expenses? Because if your net worth is growing along with your expenses, or your income is growing along with your expenses, then it doesn't really help. You're just keeping pace. And so, is my quality of life actually improving, staying the same, or getting worse? And that's a lot easier to measure than looking outside. And I think for most people, they're in an individual recession for the last couple of years. Now there's ways you can just change that individually for yourself. Like, you can choose to do the things that will improve your life. But that doesn't mean that life isn't getting a lot harder for a lot of Americans over the last couple of years.
1,000%. Well, Joe, thank you so much for coming on the show, my friend. Any parting thoughts before we wrap up? And also drop us your socials. Where can people find you?
Yeah, I'm most active on YouTube. Heresy Financial is my YouTube channel. I'm second most active on Twitter. My handle there is at Heresy Financial as well. And then I just launched a new newsletter. I call it Letters from a Heretic. It's free. And you can get that in the description or on my website. You can get that in the description of my YouTube channel.
Cool. Yeah, we'll also have all that in the description box down below, guys. If you enjoyed this content, comment, go Joe, go in the comment section. Go Joe, go. Also, hit the like button, subscribe to the channel if you haven't already, and I will catch you in the next episode. Bye, y'all.